So here's the big question. You're interested in value investing and valuing and evaluating businesses on a deep level, but you don't know how, even after researching for hours, probably dozens of hours, hundreds of hours on the internet, and because nobody else shows you how to do it. This podcast has all those answers and much more about value investing and finance. My name is Jason Rivera. Welcome to Value Investing in Your Car. Hey, Jason here. Been a couple weeks since I posted a new video. Apologize for that. Been caught up on some deadlines. Today, we're going to get back to the investment analysis, and today I'm going to cover Zillow for you in this investment analysis video. Before I get to that, though, I need to let you know you can get this series podcast anywhere in the world for free on all major podcasting platforms, Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the Value Investing in a Car series anywhere in the world for free. Plus, please remember to subscribe and hit the notification bell if you're watching on YouTube, so you're notified every time we release a new video, and release new videos all the time. Okay, so it's been a couple weeks. We're getting back to these investment analysis. I'm looking over here on my other screen. We've covered so far Archer Daniels Midland for, I believe, Andrew W. We've covered, and I need to go back up and fix some of these. I've missed some because I've been MIA the last couple of weeks. So I apologize for that. We covered Smile Direct Club for Brian L. We covered American Airlines, Walgreens, CVS, Simon Property Group, U.S. Steel Corp for Cody S., T-Mobile, IBM, Cody, and ExxonMobil. And I think a couple more. I'm missing some. But I will reference those videos if we come across anything that I've talked about before. So I don't bore you to death. You can just go watch those videos. If you want to watch those videos that I referenced, those will be linked below this. There's also links below this to get you some free stuff to help you become a better value investor and help you evaluate stocks better and faster. Below this as well, I'll tell you how to get that at the end of this video. And I have to put a disclaimer on here because I didn't on the first couple of videos and people didn't like that. So these are for informational purposes only. I do not own any stock in anything I talk about positively. I do not short sell, so I don't short any, or I don't have any shares short. There we go. And any stock that I talk negatively about. This is going over my preliminary analysis checklist in a visual way. And I'm doing this to help educate people on how they can better evaluate stocks based on what the numbers say. So let's get to it. I'm going to bring you to my other screen here. This out of the way. Okay, so as always, I haven't done anything on this stock other than bring up the information. Zillow, of course, I know what this does. Unlike some of the stocks I've talked about, I know what this stock does. It is a website where you can search real estate, and you can search for agents, and you can search to buy single-family properties. You can look for prices to potentially sell your property for as well, although their algorithm or whatever they use is notoriously way off. So if you're looking to do that, I would be extremely careful. But here, in terms of analyzing the stock, here we go. So this is a bit concerning. This likely means that they aren't profitable, that not being here. Is it a huge deal? No. As I've talked about in many other videos, I don't really care about PE too much. But with it being not even showing up, that's not necessarily a good thing. Maybe some good news came out on them because they're up about $8.40 a share as of this recording. So that's interesting. I might look into that depending on what the numbers show. Okay, spectacular growth in the last decade, from $30 million in revenue in 2010 to just under $3.5 billion in the trailing 12-month period. That is a gigantic jump. Of course, what is that? 100x plus, 150x ish? No, 100x plus, which is frankly insane. Operating income, they've been unprofitable every year on an operating income basis every year in the last 10 except for 3 of those, and they were barely profitable in those 3 years. Not great. I look for operating profit margins above 10% on a consistent basis, and they haven't hit that threshold at all. And most of the time it's been negative over the last decade. So that's not good. No dividends. Frankly, didn't expect that. Earnings per share keep getting more and more negative over time, from negative 17 cents per share in 2010 to positive 6 cents a share in 2012, back down to negative $1.44 a share in the trailing 12-month period. So, because they're being unprofitable so long, they've issued a ton of shares, from 71 million in 2010 to 217 million in the trailing 12-month period. They're issuing shares or selling new shares on the market to raise cash so they can continue growing and funding operations. And they frankly have to do that or issue debt to stay alive, because they aren't creating any operating profits. This is interesting. So free cash flow went from negative 699 million at the end of 2019, or for the full year 2019, to positive 692 million in the trailing 12-month period. My guess would be that they've issued debt along with selling shares, which is why their cash flow is so positive this year compared to so negative last year. We'll prove that out here in a second. ROIC again, negative every year except for 2 years in the last decade, and negative 2.5% in the trailing 12-month period. And they definitely have issued debt from last year. I can tell right now, because their ROE is higher than the ROIC, and the percentage difference, or from 2019 to now, is higher now than it was then. Hopefully that made sense. It sounded weird when I said it. But that means, because ROE is levered by debt, the more debt a company has, the higher this number is compared to ROIC. Negative 8% ROE right now, negative 2.5% ROIC. Get out of here. Notification. Okay. Free cash flow, again, hugely positive this year. Not great most of the rest of the decade. I'm assuming they issued a bunch of debt. And again, I'm assuming because of this that they issued debt. So they issued debt to raise cash. The reason I'm assuming this is another sign that they issued debt, pretty significant debt in the last year, is because many companies have done this for the coronavirus stuff to get some kind of margin of safety. So double-edged sword in terms of, yes, you want to have more cash, but if you're not profitable like Zillow is, then you either have to sell shares or you have to issue debt, which is not the greatest way to do things. Okay, debt, yep, higher as a percentage of the balance sheet. Oops. I don't think this matters. Yeah, cash conversion cycle doesn't really matter for them too much, although they started selling houses around 2018, 2019 timeframe, so that's probably what this number's from. Frankly, I don't even know if they're still doing that anymore with the coronavirus stuff. I don't know if they stopped that. I'm assuming they lost a ton of money on it. Debt to equity ratio of 0.54 is pretty good, actually. I look for anything below 1 to consider as a potential investment, but it needs to be above 0 as well. If it's negative, that's really not a good thing, which I explained in other videos, and I might have explained in the Exxon Mobil video and the Cody video. This is not good. Interest coverage ratio of negative 1.1 rounded up. The interest coverage ratio shows that if it's positive, it shows a company can cover its current interest payments on its debt with its current earnings. Because this is anything above 1 shows that. So the company can do that. When it's a negative, that means a company cannot cover its current interest payments on its debt with its earnings, which of course makes sense because it's unprofitable. But again, not a good thing. Just because you already knew it doesn't make it a good thing. Okay, so their debt levels, their cash levels have gone up by about 1.2 billion in the last year, while their debt levels have only gone up 0.04. That doesn't make any sense based on the other stuff we saw in. Let's see. I would assume that their debt levels would have been higher than that based on their ROIC compared to ROE. Cash levels higher. Quite a bit higher, about 1.4 when you can include cash equivalents, and short-term investments. Inventories are lower. Again, I'm assuming they're not selling homes anymore. They might have gotten out of that. Goodwill, I've talked about in several other videos. Cody, ExxonMobil, I think US Steel maybe as well. I'm not going to talk about that here because, again, I've talked about several videos, but it's not good, in my opinion, in 99% of the time. So that about $2 billion in value would be wiped off in any kind of valuation I did of Zillow. Current debt is actually way down in the last year plus. But the long-term debt is up by about 300 million, 350 million in that time, which still I would have assumed that number would have been higher, but still not great. So 2 billion, what is their market cap? Wow, they have a $31.4 million, $4 billion market cap. I would have not expected that for a mostly unproductive or unprofitable company. Nothing of major note here. Their balance sheet is actually in better shape than I expected. Has more cash, short-term investments, and cash equivalents than debt, which is great. Frankly, it's just a little bit surprising to me. Let's go to the cash flow statement, see how much debt they actually issued, not just kind of the final number. Purchases of investments. So they bought something for almost just under $2.9 billion in the trailing 12-month period. I would want to know what that was if I were to consider an investment. And they also sold something for $1.54 billion. Again, I would want to know what those are. This could be maybe they sold their inventory in their houses they were trying to sell. Maybe they sold that entire business. Frankly, I haven't seen anything in the news about them buying anything, but I don't follow them, their stock closely either. Okay. Again, nothing major here in terms of issuing debt. They've issued about $630 million in debt in the last year, which frankly, again, less than I expected. And actually, their balance sheet and cash flow statements are cleaner than I expected. Let's go to their valuation. I would guess it's off the charts since they are unprofitable. Again, I don't really care about PE and price to cash flow and forward PE much. I do use them as basic references, but the number I care more about here is this one, and it's negative. So that's the first time we've come across this. Usually you don't see this very often unless it's an insurance company. So what does it mean when a company's enterprise value is negative, which is what this means? Or I guess it could mean that their operating profit was negative too, wasn't it? Yes, it was. So that's not a surprise then. We'll go into that another time, what it means when enterprise value, or what it could mean when enterprise value is negative. but it can be a good thing. In this case, it's negative here because its operating profits are negative. So again, I'm not going to get into that at this point, but I can tell right now that off these valuations, it's massively overvalued just on a basic, and I can't even do my basic valuations on it because it requires positive profitability on an operating income basis. My kind of back of the envelope evaluation, sorry. So I can't even give a value on that either, but so sorry, I got off on a tangent here. I noticed something else. So earlier I said they issued about $630 million in new shares to generate cash flow. They generated $692 million in positive cash flow total in the last 12 months. So when you subtract out the debt issuances, they've only earned about $60 million in free cash flow in the last 12 months. Sorry. So getting back to the valuation, I can guarantee they are massively overpriced, even though I can't give you a firm number on them because, again, I can't value them even using my basic, taking a drink of water, my basic back of the envelope valuations because they're not profitable on an operating profit basis. And even if I were to subtract, let's go over here, I'll give you an example. If I were to value them on a free cash flow basis, which I do sometimes, I would subtract the 630 million here because that came from debt issuances, which again should be hopefully a one-time thing. I would subtract that, so it'd be about $62 million, and even at a 10x multiple, which I wouldn't value them at, that would put the entire value of the company of Zillow at worth about $620 million plus cash, which was so about $4.5 billion plus cash, multiple plus cash minus debt of, where's the total debt? 2.1 rounded up. So even in that scenario, I would value its stock at about $2.5 to $3.5 billion. Its operations plus its cash minus its debt. And again, this is how I value most companies. One of the ways I value most companies is a basic back of the envelope valuation like this. And that's not even close. It's $31.5 billion market cap right now. So this is 10x almost overvalued compared to what I consider it. So it's massively overvalued. For those reasons, or for that reason, I would stay away from Zillow stock because, again, about 10 times overvalued. It's not even close. Its financials are okay. Its valuations are off the charts. So I'd stay away from its stock. But I'd love to hear your thoughts on it. If you own this stock or if you're thinking about buying it, I'd love to hear your thoughts in the comments below. If you're watching on YouTube, make sure to like, love, share, subscribe, comment, and hit the notification bell so you're notified every time we release a new video, and we release new videos all the time. A couple weeks from now, I've got a bunch of videos on tap to analyze for somebody who commented on my YouTube videos. He put 4 stocks on there that he wants me to analyze. I'm going to do that in a couple weeks after the new year. So if you want me to analyze a stock for you, I'll do that. The only things I will not evaluate are banks and insurance companies, but I will evaluate stocks from anywhere in the world. I look all over the world. So if you want a stock anywhere in the world other than banks and insurance companies, I will do so. You just need to let me know in the comments below. You can also do that on the podcast as well, and we'd also appreciate a review on the podcast because the more reviews, views, and listens we get to our podcast and videos and content, the more people we can help. If you want to learn more about how to evaluate stocks faster and better, I have some free resources available for you below. We have my 5 free gifts, which as part of that, you can get my investing templates and valuation templates, which include the full preliminary analysis checklist of this visual thing we just went through here. You can also get information or our guide, 7 tips to picking great stocks and 3 times you must sell. You can get that for free, or you can also get a free PDF copy of my book, How to Value Invest, at the links below. And if you're looking to learn faster and want to learn how to become a better value investor faster with some of my help, you can get information on our masterclass below as well. But until next time, have a great day. Talk soon.